Morning to everyone. So while we keep waiting for the rest of the group, if you have any questions, it's the right time to ask your questions. So
Sorry, but it seems that we don't hear you.
So can you hear me now?
Yes, thank you.
So I've got to mute one of my presentations. Just give me a second. I will tune off and tune out and tune in. So I just had to mute audio in one of my devices. So can you hear me?
Yes, now we hear you.
Perfect, thank you. So today's lecture again about the swaps. So today we're going to have two lectures. The first one is dedicated to the swap contracts. The second lecture, number 5, is dedicated to swap contracts. While lecture number 6 that kind of I held today is dedicated to the credit risk. So the credit risk is a very important part of derivatives trading, because every derivative contract bears significant credit risk. But in fact, these two parts, lecture number 5 and lecture number 6, are not tightly bound. So it's just random order. It's not random, in fact, the credit risk can be each type of derivative has credit risk. So we talk about this topic during this particular lecture, just because this is not very big. This is not very big lecture. That's the only reason. Why do we discuss credit risk right after the swap contracts? So swap contracts are quite simple. In fact, they don't require any specific pricing or something. So they're very simple. Why do we study these contracts? Why do we focus on these contracts? Because swap contracts are used to derive forward interest rates. So as far as you remember, we have forward rates and spot rates. Spot rates is what we get. Spot rates is what we get from the market. Forward rates are rates and further dates. So if I'd like to lend you money today, I charge you with a spot rate. If I'd like to lend you money tomorrow, our rate gonna be called forward rate. So if we have a contract that starts tomorrow, next month, next year, next quarter, and this is an interest rate contract, the rate that is stated in our contract is called a forward rate. What about swap contracts? If I have a contract, a swap contract, and I have a rate that is linked from this that is linked to this contract, or that can be derived from this contract, should I call it a forward rate or a swap rate? So we often call this rate a swap rate. But when we build a forward curve, we can use swap rates to build a forward curve. So please don't be confused with those notations. And I hope that you have read our previous lecture material regarding different interest rates, curves, etc. We're not going to focus on this material during the lecture, but if you have any questions regarding these curves, spreads, and so on, please don't hesitate to ask me via email. So let's go forward. So basically, a swap is an arrangement between two parties to exchange cash flows in the future. We have to define the dates when the cash flow has to be paid. And we have to determine the way, how do we calculate these payments? So let's imagine that I'd like to negotiate a swap contract with you. First of all, we have to determine who is paying fixed, who is paying floating. We have to define currency. Do we use the same currency, I mean both sides? Or, for example, I pay you fixed rubles, you pay me floating euros. Or I pay you floating US dollars, you pay me fixed US dollars. So first of all, we have to focus on our financing. I mean, we are legal entities because swap contracts are over-the-counter contracts. They're not traded basically between individuals. Swap contract is a contract that is traded between legal entities. Nearly always, one of the parties is an investment bank, a retail bank. So this is about banking, mostly about interest rates and exchange rates. These contracts are all about exchange rates and interest rates. So, and that's why I'm talking about our financing and our operations. So first, before we negotiate a swap, we have to determine our business needs. What do we need? What do our corporation requires? Do we, for example, we have euros and all our payments in euros, and we launch operations in America, and we feel that we have to buy US dollars, for example. We can enter a swap contract while we pay fixed euros and we receive fixed US dollars, for example. That's our business need. We need US dollars at fixed rate for like 5 years. This enormous big contract. Well, for 1 year, we need fixed US dollars, for example. Or we have a credit. The credit is floating, and we feel that this credit that is linked to LIBOR or something else, so our credit that is linked to an indicator is a burden. We don't want to bear interest rate risk. We'd like to eliminate interest rate risk, and to get rid of this type of risk, we'd like to enter swap contracts. So we are willing to pay fixed, and we require a counterparty that is willing to pay floating. So before we negotiate any swap contract, we have to define our way of financing. We have to define our operations and our business needs. So as soon as we know what currency and what rate do we require, we have to define a notional. So swap payments are calculated as follows. We fix a notional amount, like 10 million US dollars or 300 million euros. Do we pay 300 million euros? Do we pay 50 million US dollars? No, we don't. We fix this notional amount to calculate our payments using these notional. So if we fix notional like 100, every payment date, we will multiply 100. For example, we have a very simple swap, like pay fixed, receive floating, the same currency, US dollars. The notional is 100 US dollars. So every payment date, we multiply 100 by fixed rate, and this is what a fixed rate payer gonna pay, or a fixed rate receiver gonna receive. These series of fixed payments, this part of the contract is called a fixed leg. Another party who is dealing with a floating rate at every payment date multiplies 100 by an existing rate, like LIBOR plus spread or any other rate, and gets an amount that this party gonna pay. So, and that's for, we need this notional. Basically, the frequency of payment is monthly, but somehow there are so many variations of swap contracts. Like we have irregular payment schedule. It is quite possible to have any type of variation, like different schedules, different payment dates, irregular payments, whatever. So we will focus on like regular swap contracts. Payments are calculated and settled monthly. Payment dates for both legs are the same, so we don't have any mismatch in timing. We pay and we receive at the same date. So what is netting? Netting is a basic thing in derivatives trading and derivatives operations. When I have to pay you like 90, you have to pay me 95. We don't make like two payments. Our payments are netted. And if I have to pay you 90, you have to pay me 95. You pay me 5. That's what is netting. So, and it was once it was an amazing story. So like nearly 20 years ago, and in 1994, there was a story in St. Petersburg where a trader who was trading swaps, OTC swaps, initiated a netting payment of like 30 millions of rubles or dollars. So the amount was really impressive. It was 1994. And nobody knew about this notion. So nobody just knew what the netting is. And they decided that this person might be engaged into a fraud activity. And he was literally put to court. And the only thing that helped to manage this case was a newly issued book about trading. I don't remember the author. It was something very basic. But at that time, at the former Soviet Union, these books were really rare. And this book helped to take this person out of the prison, because he was literally put in prison. It was like one step from being sentenced to crime. And this book that described the notion of netting and swap contracts and everything else, that was issued by that was issued in Russian, literally saved the person from being put to prison. So what do we have here else? Payments are netted for a contract can be viewed as a simple example of swap. So when we price a swap contract, it's very often when we consider these two payments as a series of forward contracts, because in fact, each payment is a forward contract with a fixed start date. To be honest, it's not a, it's sometimes it is a FRA contract. I hope you do remember these 3 letters from our previous lecture. So we can consider each payment as a forward contract, or for interest rate swaps, we can consider each payment as a FRA contract. So, and there at the bottom of this slide, you can see that swap has an exposure to counterparty credit risk. And we're going to talk about the credit risk during the second part of the lecture. So why do swap contracts have higher exposure to credit risk than forward contracts? In fact, swap contracts are longer, and the amount that is expected to be received or to be paid might be the same, but the term is longer. And that's why the credit risk plays a significant role in valuing swaps. So that's the basic thing about swaps. And now we're going to have a look at swap contracts variations. So what do we have here? Interest rate swaps. So we have plain vanilla interest IRS. IRS is interest rate swap. In Russia, we often call them EIRS. As for currency swap, regarding or abbreviation, we call them CIRS. So that's just jargon. So plain vanilla is when one party pays fixed, another party pays floating. There might be basis swap when two different trades. The difference between two different trades is paid. What about the currency swap? We have already discussed this contract. So there are two currencies and a variation in fixed or floating rates. So while interest rate swap, it has a local instrument, and we have interest rate swaps negotiated between like banks and local companies that they're not importers or exporters. And interest rate swap in practice, it's a way to get rid of floating rate credit. Currency swaps, that's a part of importers or exporters business. So these contracts are required by companies that like to eliminate an exposure to foreign exchange rates. So they like to convert all their operations to local currency, to one currency, local currency or domestic currency. It's very often the importers and exporters convert their operations into local currency. And sometimes this type of derivative contract is used to deal a credit that is issued abroad. So that's an attempt for a big company to convert a credit that issued to a foreign subsidiary into a credit that is issued to, like, imagine a company that's originally found in Russia. They have their subsidiary in, let's say, in the UK. Their subsidiary in the UK gets a credit, a floating rate credit, linked to, let's say, a 3-month LIBOR. In order to get trade and exposure from LIBOR, they make a series of internal contracts, and they move these exposure from their UK subsidiary. They move it to a balance with the Russian company, and this Russian company enters a swap contract with an investment bank to convert these floating payments into fixed payments, and probably into fixed payments in a local currency. That is how a corporation can get rid of FX and interest rate risk. So that's a very basic thing. There's a core thing of derivatives trading, eliminate these types of risk. So at the same time, we have equity swap. While one party is paying proceeds from a selected equity, and another party is paying fixed payments. So we use these equity swaps as building blocks to create FANEX structured products. So these types of products are linked to a basket of equities, and a typical FANEX is a derivative product that pays you if the performance of the worst equity among reference underlyings is not worse than something. So, in simple words, I have like 4 equities. I track the performance. I track the price of these 4 equities. I have a period, an observing period, or an observing date. If at a pre-specified date or during a fixed period, an observation period, the worst performing stock's price is not lower than a selected barrier, this product pays you. If the performance of the worst performing stock is worse than this contract, it does not pay you. That's a simple mechanics of FANEX. You can have a look at this product in its structured products basics. So to price this product, we use equity swaps. So we have index swap. That's two legs, or one leg is linked to, to an index. Another one pays fixed. So what does it mean, a leg linked to an index? One leg pays the same amount of money as the index would pay. So the index swap, one party is paying fixed amount of money. Another party is paying as if an index. So entering index swap is the way how you can get index performance for fixed payments, or you can get rid out of index to eliminate index from your portfolio and get fixed payments for fixed payments. So what is a total return swap? One leg is fixed, another one pays total proceeds from an asset. It might be a bond plus its coupons. It might be equity and its dividends. Well, any type of asset. Total return swap is used to eliminate any risk from an asset. A commodity swap, that's the same thing. Like index swap or equity swap, one leg is fixed, another leg is pays the same amount of money as this. One leg pays fixed, another one is pays an amount of money that's equal to a commodity price. Volatility swap, that's the same thing, but it pays an amount of money that's linked to volatility of a specific asset. So let's focus on some details. Interest rate swap, as we have already discussed. Floating rate, that's usually quoted in LIBOR terms plus spread. Swap contracts are designed by ISDA, that's the International Swaps and Derivatives Association. And basically, swap contracts terms are more or less standardized. So basically, the payment that is linked to the floating rate is determined at the beginning of the period. But we make a payment at the end of the period. So we know an amount we had to pay in advance. But there is some other variations of swap contracts. I mean that while exchange traded contracts are standardized, and we're totally unable to make any change in this contract. So by their nature, it's just impossible. As for ISDA documents, well, they issue templates, a contract with lots of appendices. And in these appendices, you can specify, you can underline something, or you can, there's always a point like other. There's some options you can choose from, and there is like other. So you can add something. There some details of the contract allows you to specify your own details. Some points are not allowed to specify your own details. So, and these contracts are used by back offices to calculate payments. These ISDA documents are very detailed. They specify everything. They specify like at what date, at the account, how to make these payments, how to calculate this rate, etc. So, I mean, they're incredibly detailed. And mostly derivative traders don't deal with these tiny details. They're focused on contracts itself and pricing contracts. Salespeople, they deal with those contracts, but in fact, they focus on big details. So people from operations are mostly dealing with these tiny details and payments and so on. So, I mean, as simple as the swap contract and an appendix, it's about 30 pages with different choices. So they're incredibly detailed, but we don't deal with these things. In fact, if we're not working for operations. So do you have, before we go to any details, are there any questions or something? Okay, it looks like you don't have any questions. So just give me a second. I'll charge. Oh, I'm trying to charge my iPad. Just one second. So I'm here with you, and I fixed my problem with the charger. So we're going to talk about interest rate swap mechanics. So consider a 2-year loan with a rate of interest specified at 6-month LIBOR plus 0.5% per annum. So the life of the loan is divided into 4 periods. Each period has 6-month length. For each period, the swap rate is fixed, while the floating rate is equals to 6-month LIBOR plus 0.5%. We take the 6-month LIBOR rate at the beginning of the period, like at the 1st of, let's say, September. We fix this amount, but we pay this amount at the end of the period. So I have highlighted with green and yellow the timing. So just have a look at these green and yellow timings. That is important. So I don't want you to be confused with timing of these contracts. So it's important to take the right rate at the right period of time. So the swap and details. And on this slide, we can see how a swap contract transforms liability. So consider a company A and consider a company B. So we can see a company A. Company A pays LIBOR to company B, while the company B pays LIBOR plus spread. At the same time, company B pays fixed amount to company A, and company A pays out this fixed amount of money. So what's going on here on this slide? In fact, we have company B that feels quite comfortable paying that pays LIBOR, but in fact they would like to pay probably they would like to pay fixed amount of money, because paying floating, paying LIBOR plus spread is not a good idea for a company if it is not a financial institution, and if selling interest rates is not its core business. So we have company B who's paying LIBOR, and we have company A who's paying, as far as we can say, who's paying fixed. Yeah, who's paying LIBOR. So if we look at what we have at the bottom, in fact, it might be the company A is like oil refinery. Company B is like a clothing retailer. So company A and company B, that's quite difficult for these two companies to find each other, and that's why they need an investment bank to negotiate with company A and to negotiate with company B. It means that they need a financial institution and investment bank to act as a middleman. So in the next slide, we're going to have a look on details. So while these two companies transform their liability, they eliminate the credit risk to some extent, because when two companies, company A and company B, negotiate a swap contract, company B bears credit risk of company A. I mean, if company A defaults, company B won't receive the payment from company A, and vice versa. But if they have a financial institution as a middleman, the default of company A or company B won't affect payments to the company that is not that is not in a default state. So if company A defaults, company B continues receiving payments from the company, from the financial institution. But financial institution bears this credit risk because they start receiving payments from company A. So this part, I explained the most important thing about this lecture, interest swaps comparative advantage. So before this slide, we were just talking about things in general. There's in this slide, I don't explain why do we have these rates. Like you can see that we have 4.7, we have 5.015, etc. So we have different rates here, but there's no explanation, and it looks like financial institution looks like a magic box here. We have 5.15 entry, and we have 4.985 just out of financial institution, and there must be like 0.030 lost somewhere. There's obviously something is missing here. So now it's time to have a look at the magic, what was going on here. So look, first we're going to talk about comparative advantage. That's what the comparative advantage is. And then we're going to talk about the mechanics, the details. So, I mean, that's the core thing on this slide. Consider a company A that might have a comparative advantage when borrowing in fixed rate markets. For example, consider a big corporation in the Russian market, or consider a financial institution, a big bank, and consider a newly founded business. The credit rating of a big corporation or a well-established bank is high. And that's why this market player is offered lower rates than a newly founded company with an unknown credit history and operational history as well. So consider a company A that has an evident advantage borrowing fixed. Market offers company A 5.2%, while the same market offers to company B the same currency at 5.8%. So it must be that the credit rating of the company B is lower than the credit rating of company A. And that's why company B is charged a higher interest rate. At the same time, it might happen that the same company A don't have the same preferred borrowing options at international markets. So this company is offered 0.3% spread added to LIBOR if it borrows floating rate. At the same time, company B is charged only 0.1% for floating rate borrowing. In this ideal world, when these two companies have different operations, different advantages, they both have advantages, they can make a direct negotiation. So company A, in this story, company A borrows fixed and company A pays 5.2% for fixed rate borrowing. Company B borrows LIBOR plus 0.1% because it has a nice option at fixed rate at floating rate market. These two companies negotiate, and company B pays fixed to company A, while company A pays LIBOR to company B. This is the case when companies' needs differ from what they offered. I mean, company A is offered an attractive fixed rate, but in fact, company A requires LIBOR. Company A would like to pay floating rate, but this particular company is offered an unfavorable rate at floating rate market. At the same time, an advantage that is given to the company B differs from company B needs. So in very simple words, we have two companies that are offered nice deals, while this is not what they require. They just require the opposite. Company A would like to pay floating, company B would like to pay fixed, but they're not. They're offered just the opposite thing. In fact, this is a very rare case. So these two companies are offered good deals, but they don't want to take these good deals. They would like to have opposite credits. And what is the most unbelievable, that these two companies with matching requests were able to find each other. So I mean that they have their specific terms of their loans. They have their specific amount of these loans, their specific timing. And in fact, that's very difficult for companies to enter a swap contract if these companies are not financial institutions, if they don't actively trade swaps. I mean, an oil producer and a retail store, if they're not corporations, they just won't be able to find each other. It's going to be really difficult. So here we can see the comparative advantage. This is what we have here. They're what they're offered. Then in an ideal world, well, these two companies managed to find each other. They will have this chain, and their comparative advantage is what they save from this operation. So company B, if company B don't find company A, they will pay 5.8. If they find company A, they will pay 5.4. 0.4% difference if we talk about a fixed lag. What about the company A? If company A finds company B, they will pay LIBOR plus 0.1. If they don't, they will pay LIBOR plus 0.3. What's the difference? 0.2 difference. So so they save 0.4 on fixed rate loan. They save 0.2 on floating rate loan. So it might happen. That it might appear that you think that the difference is 0.6. No, they save 2 times, and that's why the difference is greater. Look, an overall payment from this group. When we talk about the total apparent gain, we make a group of company A and company B. And if we look at like an arrow that is an arrow at the left hand side and at the arrow that is at the right hand side, we can say 5.2 and LIBOR plus 0.1, right? This group pays 5.2 instead of paying 5.8. There's the fixed lag. What about the floating rate? This group, a group of company A and company B, pays LIBOR plus 0.1 instead of paying LIBOR plus 0.3. So the difference is, you can have a look at the bottom of the page. So the difference is 0.6 on fixed rate and 0.2 on floating rate, and an overall difference that's called the total apparent gain equals to 0.8. You might have a question like, why do the company A pays the same amount of money, LIBOR plus 0.1 to the company B, and this rate is equal to the rate that company B pays outside? Like, what's the profit? They have their profit on fixed lag. Company B saves 0.4. Company A saves 0.2. You might think that there's something like a bit unfair, but they negotiate these rates, and it might happen that company A that saves just 0.2% is quite happy with saving at least 0.2%. And they're quite happy with company B that's saving 0.4%, because these rates were like terms of their negotiation. So do you have any questions regarding these very simple comparative advantage scheme? Okay, it looks like you don't. Perfect. So as I mentioned at the beginning of the lecture, interest rate swaps can be considered as a series of FRA as well. So, so we have already discussed phrase last time during last lecture. So we can move forward because we're not going to talk about price during this lecture. During this lecture, we're going to focus on interest rate swaps pricing and valuation. So I hope that you do remember that pricing is what we do once and valuation is what we do during the life of the contract. So these pricing and valuation operations are quite similar to what we do with forward contracts. So I'd like to introduce the following notions for fixed rate payments and floating rate payments, fixed and with indices fixed and FLT. What is important? The price of the swap, similarly to the price of the forward, is not a price in US dollars or euros or rubles or Japanese yen. The price of the swap is the swap fixed rate, analogously to the forward contract. So pricing a swap is determining this swap fixed rate. What do we have here at the bottom of the slide? A very simple logic. If interest rate increase after the swap initiation, we have present value of fixed leg payments lower than present value of floating leg payments. If interest rate increase, the swap will have a positive value for the fixed rate payer. If interest rate decrease, we have an opposite thing. So the present value of a fixed leg is greater than the present value of floating leg. So the abbreviation PV is present value. Positive value in green at the bottom of the page is like positive present value. So PV is not an abbreviation for positive value. I want you to look carefully at the slide. So I introduce some notions here, the accrual period. So could you please have a look at the slides and ask me some questions if something is, if something remains unclear. So I hope that everything is quite clear. So you just to calculate the floating or the fixed lag cash flow, you need to take the accrual period and multiply it by rate. I can see that I omitted multiplying by R. Look, AP sub FLT multiplied by R sub FLT equals to, I'm reading the first line of the second block, equals to number of accrued days FLT divided by number of total days during the year. They must be multiplied by R FLT because we're calculating the cash flow. So there must be R here. So the first two lines requires correction from my side, while what we have at the bottom is correct. So we have accrual period multiplied by the difference in rates. It might look a little bit strange that I write cash flow, but there are no dollars or no rubles or just nothing. I'm multiplying rate by number of days. And you might question me, how do you get currency if you multiply dollars or if you multiply days by rate? How do you get currency? Well, in fact, because the notional is something that we think about, we focus on these days and rates, and the notional is something that just used a multiplier at the end of all these calculations. And that's why it's very common when we omit the notional when we talk about swaps. If you feel uncomfortable omitting the notional and you believe that it's quite ridiculous to multiply rates by days and get dollars, you can add notional here. But in fact, we often omit it. That's the reason why I don't have any currency here. So we can, another approach. We can, while this is a very basic slide, like pricing, I introduce those number of days multiplied by rates, etc. On the second slide, I like to focus on treating swaps as bonds. So swap pricing and valuation as bonds. This part of slides, this part of several slides, is dedicated to treating a swap as a bond. So assume without changing the value of the swap that at the end of the contract, we exchange the notional principal. In fact, we don't do this, but let's imagine that we do this. Then the swap is the same as a contract when company A loans company B, an amount of N at the LIBOR rate, and company B lends company A an amount of N at a fixed rate. So if we just add the exchange of notionals at the end of the swap life, we can consider this contract as two bonds with fixed or floating coupons. Very simple. So we can use B sub fixed and B sub FLT to as values of these bonds. So at the contract initiation, we have these 2 bonds prices, right, absolutely the same. So when we the same thing, when we enter into a forward contract, we believe that its price is fair. When we enter a swap contract, we believe that its price is fair. So no one gets benefits in advance. No one pays another party, and that's why at the beginning of the contract we have this, what is important. They have the same values. So swaps pricing and valuation as bonds continued. In the middle of this page, you can see the value of a fixed bond. I think that this is a well-known formula. Based on the value of a fixed bond, we can derive the fixed rate. So the first formula on this slide is the bond price. The second formula is a fixed rate or the coupon that can be derived from the value of a fixed bond. Do you have any questions regarding these formulas? Well, I think that in fact you don't. It's a very basic thing. So I like to support this formula with a very simple example. So if we're pricing a 5-year LIBOR-based interest rate swap with annual rates 30 to 360 day count, this is 30. It means that we use 30 days as the length of 1 month, and we believe that 1 year has 360 days. So we use these numbers to calculate fractions as multiplier of interest rate. 12 periods, right? 12 periods. Like we call it a convention. In all trading systems, convention is like act to act. It means that we use actual number of days in 1 month and actual number of days in a year as a multiplier to each period. There are 30 to 360, 30 to 365 conventions. And basically there are like all possible combinations, like act to 360 and so on. But it is it is important, but if you basically these things are introduced on the level of a pricing system, so you just don't have to calculate it manually. When regarding the question, so there is a question. Could you clarify why we need in this example 30? We use only year. In fact, what we call a convention, like 30 to 360, is we always use 30 to 360. We always use two numbers, regardless on compounding periods, regardless on pricing periods. So it's just in every system, in every ASD document, you will always see two numbers: number of days in a month and number of days in a year. These two numbers are always used together, and that's what we call a convention. That's just practice. I mean, the same thing as like it looks really useless, but that's the practice. We always write like this, even if we have like yearly coupons, yearly payments. So in this particular example, we don't use 30 and in any way. Yeah, it's convention, and we just use it like this always. So to price the swap, we can use an Excel or a financial calculator or whatever. So we just have to get the we just have to calculate discounted prices. If you don't have any questions regarding this formula, what to do with February? Nothing. I mean, and that's why we use this convention 30 to 360, or act to act, or act to 360 to 360 to avoid any how to say, to avoid any interpretations. So imagine in an investment bank, we have operations, we have traders, we have sales, we have quant teams, and probably we have some people in accounting and some people who make payments, and people in financial management who make financial reports. All these people have to know how to calculate the price. It's very common thing that this convention is introduced on a system level. I mean, in IT system, we just put a mark which convention is used. This mark is put on a front office system level, as trader negotiates a particular contract, a particular trade, the trader specifies a convention that is applied, and this info is linked to a trade info, and this info moves from front system to middle office and to back office with this convention embedded into trade details. And nobody just thinks about whether it is February or March or something. This convention is used for pricing, but when it comes to payments, these dates and this back counting and so on, to make a payment, to make a settlement, operations use dates. This convention is what we use to price. But if I have to make a payment on the 28th of February, I will make it on the 28th of February. But the price can be calculated using this particular convention. Do we have a Convention Act? Uh, 280. No, because 280 is like 3/4. The first number in the convention is a number of days in a month that is used to derive any price, any rate, etc. So the first number is the number of days that is used in pricing. The second number is a number of days in a year that is used in pricing. So the first number might be 30 or actual. The last number can be 360, 365, or act. And all combinations of these two act number of trading days. I have never seen it. Number of trading days. No, we have. It might happen that somewhere in the universe there is a convention that's linked to trading days, but I've never seen it. So do you have any questions regarding this example at pricing? I think that you don't have any questions regarding how do we get present values. So having swap price, we can introduce the swap value. So the value, we have a value to the fixed rate payer and a value to the floating rate payer. So first, let's introduce the value to the fixed rate payer. So we have notional amount. We have to take notional amount and to multiply it by the difference in fixed swap rate times the stated notional amount. So NI is the notional amount. In brackets, we have the difference in payments. And that's the value of a swap. So could you please have a look at the slides? There are only two small formulas. If you have any questions, don't hesitate to ask me. So is everything clear? Okay, is everything is clear and you don't have any questions? So could you tell me, please, if CF suffix 0 is the fixed rate, what is CF suffix at T? If nobody has no questions, I hope that everyone do understand what is TI and TN. And that's why I ask you with questions. Do you have questions or don't? The second line in the second block, the fixed lag cash flow I is used in case if accrual periods are not constant, if we have a period that has a bit different rate. So if we move to, if you have a look at this bond price, you have I equals to 1, and we make a sum from 1 to n. N is a number of payments or payment periods. So if we have 1 year contract and we pay monthly, n is equal to 12. So now as we move to value, so I don't see some other questions. So I think that we can proceed with an example to make it a little bit clear. So let's have a look. You don't need to make a screenshot of a formula because I have it in this example. So consider an example. 2 years ago, we entered a 100 million euros 7-year receive fixed LIBOR-based interest rate swap with annual resets. The fixed rate in the swap contract 2 years ago is 2%. The estimated present value factors are given on the right side. So these present value factors have a look at these present value factors. How do we get them? This is how we get present value factors. So we just these present value factors, we just divide by present value. If you don't, there's a formula, present value is present value of a bond. Sorry, I don't have present value here, but I hope that you do remember how to discount. But I provide you with present value factors because I don't want you to make these calculus because it's a little bit out of the scope. So the estimated present value factors are given in the table at the right side. So what's the value of a swap? Let's have a look. So first of all, we have to estimate the R fixed. We have our present values. So what is N? This is the notional amount, NA. We have introduced the notional amount on this slide. The stated notional amount denoted NA. So look, 2 years ago, we entered a 7-year swap. 2 years ago, a 7-year contract. So we paid 5 years. We paid during 5 years. So 2 years are left. And that's why we have 5 present value factors. When we have to summarize these present value factors, we have 5 numbers. The first line in this example. Do we use as discount factor? Could you show slide with Notion? The slide with Notion. The notional amount is what is used to make a payment. So if the notional amount is 100 and fixed rate is 5%, fixed leg payer 100 multiplied by 5% by number of by convention, that's what a monthly payment for a fixed leg payer is. We use notional amount to get US dollars or rates or any currency out of days and rates. So look, we have 5 present values. To determine our fixed rates, we have to summarize these present values. That's the denominator. We have to take the last present value. In our case, the line that has number maturity 5 years. That what we have here, because we have in T sub n. We put it here, and we get like 1.3%. So we have CF fixed and 0. This equals to 2%. There was the swap price. There was this is the rate that is paid by the fixed leg. We have these 2% here in the third on the fourth line. CF cash flow fixed at T. T is the 5th year, like T is now. What do we have here? We have 1.3. So I hope that you are looking, I keep silence because I hope that you are looking carefully at the slide. So I think that we have to make a break and some basic words about this example. What's the difference between a swap and a bond? When we have a bond, we have a repayment at the end of the contract. So if this contract was a bond, it would repay this $100 million. But your swap contract does not repay you any notional at the end of the contract. You have cash flows only. So and that's why we have an instrument. So now we have an instrument that makes like 7 payments, and after we have these 7 payments, 2 payments are left and we're not going to get notional back. That's the key difference between a swap and a bond. We price it like a bond, then we have to exclude this notional repayment part because we're not going to get any repayment. And please pay attention that we have a value to a fixed rate payer. So as far as you can see that we have 7-year received fixed LIBOR-based interest rate swap. That's the value to a fixed payer. So, and now we should have a break. So I hope that the break was long enough to make your everything you planned today, and we can continue with our slides. So swap rates are used to define a LIBOR zero curve, as far as I've told you at the beginning of the lecture. So how do we build this curve? We use a bootstrapping. So we take so basically the method is the same as building any other curve out of bonds. So we just type the price, we revert it, we recalculate the price to find the rate. So, and who knows, how could we use swap rates to define LIBOR parallel bonds, to define parallel bonds, to define LIBOR zero curve, if swaps are not exchange traded? So who can answer this question? So how can we use info from OTC contract? This info is not provided by an exchange. So do you have any idea? Now this is still the swap lecture. So look, to derive LIBOR zero curve, we use swap data, and OTC contracts are entered into the trading systems, are reported to the repository systems, and that is how these rates are extracted. So when we talk about futures contracts are specified by the exchange, and that's why we know these rates. We know futures contracts price, because price is determined by market participants, and rates are defined by the contract, by the exchange. And that is how we know how to match a particular futures price and a rate that is specified in the contract. When we talk about swap contracts, to match a specific rate with a price and to bootstrap curve data, we need OTC transactions reporting. So when we say that a derivative is traded over the counter, it does not imply that the contract is not reported, that nobody knows about this contract. Swaps are electronically traded and they are reported. That's how we know swap rates. So now we have lots of types of swaps discussed, but I have already discussed these types of swaps at the beginning. So currency swap, we have already discussed it. What about the currency swap pricing evaluation? Basically, the approach is similar to what we've got in interest rate swaps. So we have to calculate the value of a fixed rate bond in currency K. This is the formula right in the center of the slide. We have to know the exchange rate and number of currency units. All the rest remains the same. Fixed coupon in currency K, present value in currency K. So we believe that the market we operate in allows no arbitrage. So we don't have any arbitrage opportunities. We cannot reconstruct any position and generate profit from nothing. So I hope you do remember the arbitrage, that arbitrage is getting interest above the risk-free rate without bearing any amount of risk, riskless profit. So the replication is entering currency swap. This I hope you do remember we did the same replication to value for a contract. So first we enter a currency swap, and we believe that its value at initiation is not zero. Its value is minus V sub I. If we short sell a bond in currency A, and we buy a bond in currency B, we're gonna have the following portfolio. So why do I add minus sign to the swap? So we say that a fixed rate payer is the one who fixed rate payer is short the swap, but we basically don't use like short or long, but paying fixed is what is desired. Like in this case, when we talk about currencies and we have two different currencies, it is obvious that I can say that I short currency A and long currency B, or I short currency B and I long currency A. So in any case, I short one currency and I long another currency. And that's why we use here minus sign. So if the initial value is positive, this side of transactions will be implemented. If the initial value is negative, we can just write an opposite side of transactions. As we believe that there are no arbitrage opportunities, so we have to determine the fixed rates of the swap such that the current swap value is zero. Because if its value is not zero, we can just generate value from nothing. So we use this replication, the first formula, just to derive the last one, what we have at the bottom. The replication method works as follows. I replicate my portfolio with different instruments. I say that there is no arbitrage and some of instruments values thus turn into zero. And what is left is used for deriving any formulas. That's how it works. So we use the first formula to derive the second one. The second one, what is important. As we proceed, we can find the equilibrium currency swap price to identify the initial coupon rates, such that 2 bonds rated par. So in currency A and currency B. If we are in equilibrium state, then the notional amounts of these two legs are equal and can be denoted as follows. So just pay attention to these two formulas. Par A is equals to S sub 0 par B. And the goal is to determine the fixed rate of the swap such that the current swap value is 0. The current swap value is 0, it means at initiation. That when we initiate the contract, there's no upside or downside for any of these two parties. Why do we have 1 here? That's just to make our calculations easier, because like, once again, B is par. So we can use like 1 or 100 or 1000 or something to determine par of the bond. And I opted for 1 to make our formulas looking a bit smoother. So B fix A, B fix B equals to 1, and both equals to par. That's what you can say on the second line. What is B? That's a bond denominated in currency A or B. So I use letter K. K is either A or B. So the third formula is general expression. So now I state that K is A, currency A. So I have a swap, currency swap, one leg in currency A, another leg in currency B. And I'd like to know a price of swap. And I'm trying to find it. So currency A, I replace letter K, a theoretical currency, with letter A, my currency, the one that is used in this particular swap. Okay, so I can write 1 par B or 1 or par. The third formula and the first one, the first and the third. And we can have this 1 equals to R fix. Now, I hope that this is clear. So we have R fix A, the expression, and we have the same for the currency B. So I'm talking and I'm at the same time, I'm looking to the chat in order not to miss any questions, so don't hesitate to ask. And we can consider an example. So I'm not going to stop in details because this example is quite similar to what we had before. So we have a US-based company. US-based company needs to borrow 100 million Australian dollars for 1 year. The US-based company decides to issue US-denominated bonds in an amount that is equivalent to 100 Australian dollars, 100 million Australian dollars. Then the company enters into a 1-year currency swap with quarterly reset and the exchange of notional. the exchange of notional. So these two parties exchange amounts in different currencies. Because the original business goal of the company was to have 100 million Australian dollars, that's why this contract is specified with an exchange of notional. So the spot rate at time zero at the contract initiation is 1.140 Australian dollars for US dollars. So when you say like AUD / USD, it is always how many units of the first currency should be paid to get 1 unit of the second currency. And these quotes are often, these currency pairs are often quoted in US dollars. So it's very unusual to say USD / AUD. So like how many US dollars we have to pay for Australian dollars. There are both types of transactions. We can purchase Australian dollars and pay US dollars. We can purchase US dollars and pay in Australian dollars. But when it comes to quotes, quotes are often written as follows, ending with USD. So that's just a market practice. So we have 3 questions to answer. What are the annual fixed swap rates for Australian dollars and US dollars? Fixed swap rates, that's what we have. That's what we have here. What is the notional amount in US dollars? Company needs to borrow 100 million Australian dollars. So what's the notional in USD? As far as we know, the notional in Australian dollars. What are the fixed quarterly payments? Here we've got some info about Australian spot interest rates and US dollars spot interest rates on days to maturity. So we have a lot of calcs in this particular example, but nothing especially difficult. So first of all, to calculate the annual fixed swap rates, as far as you remember these formulas, or you can see these formulas below, we have to calculate present value factors. Why do we have 1 as nominator? Because the par, we think that the par is 1, and to get currency, we multiply by notional amount. And that's why we always have 1 at nominator here. NAD, NTD. Do you remember this? What's this? Who can tell me what is NAD and NTD? So N stands for a number, right? What is A? What is T? Great, thank you. Number of accrued days. And what is NTD? Number of total number of days, number of total days. Perfect. So we have to calculate present values. What do we do? 1 plus R, this, we have R for Australian and for US dollars. And this is to make these calculations easier. There's rates for each period of maturity. So 90 divided by 360. Why 360? Because we have 360 convention here. R 19. Accrued days 90 divided by 360. When we work with 180, number of accrued days here is 180, and so on. So number of accrued days is what you can see in days to maturity. So after these calculations, and please you make these calculations at home, check these examples to ensure that you understand what's going on. We can get 2 periodic fixed rates. So as far as you can see, there is nothing special here, just very basic calculations. What is the notional in USD? Since the notional in Australian dollars is known, the rate is known, and we fix notional amount at the contract initiation, and that's why we just apply an existing rate to a notional amount expressed in Australian dollars, and we get the notional amount in US dollars. What about the fixed quarterly payments? That's quite easy. Look, what do we have here? Fixed rates, Australian periodic fixed rate. Here it is, US periodic fixed rate, here it is. Next slide. We have notional multiplied by what? By periodic swap rate, right? Here is a periodic swap rate. And what is important? Using annualized rate is unnecessary if payments are not made on annual basis. So what you have here is a periodic swap rate. And it would be great if you could just repeat all these calcs at home before you start this topic, before you start any quiz or home task or something. The same thing if we have valuation for interest rate swap, we can do the same thing for currency swap. So the formula, the idea looks like what we have already done. But this time we move from this formula to random moment in time. So the first part is just a reminder of what we do. We have to value our contract at time t. We act as we used to. The value of fixed for a fixed currency swap at time t is just a difference in 2 fixed rate bonds expressed in currency A and currency B. So if I issue a bond and I purchase the bond, that's the same thing. What you can say in the short formula in the center of this slide, that's absolutely the same thing. So you can see these formulas, but for better understanding, let's just move to an example. So these formulas, when they remain formulas, I think they are a bit messy. So this is the first bond. What we have is the first bond minus the second bond. Let's have a look at details, because details are important. The concept is very straightforward. What about details? So here I've got all details explained. We have the same company that needs to borrow 100 million Australian dollars, and they borrowed in USD an equivalent to what they needed to borrow in Australian dollars by issuing bonds. And as soon as they, do you understand that transaction? So a US-based company issues US denominated bonds because this is the way they finance their operations. They issue bonds. They receive US dollars because of this operation, as a result of this operation. Now they need to convert these US dollars into Australian dollars. But they don't need Australian dollars right now. They need Australian dollars as a borrowing for 1 year. And that's why they enter a 1-year currency swap, because they operate in US dollars and they have to pay in Australian dollars. So we have the fixed rate for Australian dollars. We have calculated it. The green, what is in green is what we got in the previous example. The same rate annualized is equal to 2.77. The same thing for US dollars. We got this number while we were solving the previous case. We have this fixed rate annualized, and we have notional in US dollars, and we got this US dollars notional just during the last case. So 60 days have passed. The market info is given in a table. So 60 days have passed and it's time to value a contract. We'd like to know what's the value of a contract. So now we have days to maturity and spot interest rates in Australian dollars and in US dollars. So there are different days to maturity and different rates. First, you can say a formula. VA, there's a value in Australian dollars. NA, notional amount in Australian dollars. R, fixed rate in Australian dollars. The yellow part, sum of present values in Australian dollars. Yellow, if you look to the table on the right, you can see PV in Australian dollars, yellow number. This yellow number is what you use instead of this sum, plus what you can say in red. In red is what you have 60 days have passed. That's present value. So initially, there was 360 days to maturity. PV of T sub n in currency A is a present value of a payment, the last payment, Tn, expressed in currency A. Why do we have 300 days to maturity here? 60 days have passed, 360 days contract, 300 days are left. So what is in red is what we have a PV, the last PV in this table for 300 days. And as for the currency B, I don't have these colored lines, but the logic is the same. So I tried to make this formula as clear as possible with highlights of different color and so on. So I hope you don't have any questions. So I tried to do my best. But I strongly recommend you to have a look at these examples. While you will be working at home. Currency swap can be considered as a series of forwards. I have mentioned this at the beginning of today's lecture. So the idea is quite simple. When the interest rates in two currencies are different, for example, when you have a currency swap, you have euro, low interest, sometimes negative interest rate currency, and like rubles, when you have interest rate that's that is higher than what we have for euros. In this case, forward contracts corresponding to the early exchange of cash flows have positive values. Forward contracts corresponding to final exchange of principals have negative values. So the swap will tend to have a negative value during most of its life to the payer of the low interest rate currency. So what's the idea? When you negotiate a contract, its value is 0. During the life of the contract, as you keep on paying or keep on receiving, the value of a contract differs. It might be positive, it might be negative. If you are the payer of the low interest rate currency, like you pay euros, low interest, you receive rubles and you have higher interest rate for rubles. At the beginning of the contract, the value of the contract is positive because you are expecting interest payments from rubles. As soon as the contract pays you out its value tends to be negative. So first it pays you and you expect to get some value. But after these exchange have taken place, there is a tendency for the remaining part of the contract to have in total negative values. So you can just read this part, think about it, and in reference books, this topic is discussed as well. On the other hand, when interest rates in two currencies are different and the pair of the high interest rate currency is likely to have the opposite thing, right? So if we have two parties, they share the same value, the party that pays high interest rate is likely to see the value of its contract to be positive during the most of its life. What is important? I'm not talking about that the contract is more profitable. I'm talking about the life of the contract. So imagine a very simple case, the value. What if we negotiate the following contract? I give you 100 units of something today, and you give me 105 units of money in 1 month's time. Before we start any exchange, the value of the contract is 0. As soon as I give you like 100 of something, you start earning interest. And I keep on waiting for the end of the period to get my 105, and I expect to earn interest later. So in this case, after you receive the payment, starting from the next day, the value of the contract is negative. You are not expecting any payment. You have received 100 units of money and you start earning interest or dividends or whatever. And what is left is a payment from your side. So you have a payment on your balance. That is all. And thus, the value of the contract, if we have 30 days contract, I pay you on the first day. And we believe that this is a fair trade. I mean, in terms of money, in terms of time, during the first day, the value of this contract is 0 to you. Starting from the second day, the contract has a negative value. You will pay me in 29 days. And during 29 days, the value of the contract is negative. While the value of the contract is positive to me, because I expect to receive 105 units of money, in 29 days. And during these 29 days, the value of this contract is positive to me. I'm waiting for a payment. So when we talk about the life of the contract, and when we say that the value of the contract tend to be positive during for most of its life, or negative during the most of its life, we are talking about this timing. Why do I talk about this timing? Because when the value is negative during the most of the life of the contract, I don't bear any credit risk, right? If you receive the payment on the first day and you are going to make a payment 29 days later, in this case, you don't bear any credit risk that is linked to this trade. If I default, my default won't change anything in your balance, in your operations. To be honest, my default is a small profit. If I default, your payment gonna be postponed. So you don't bear credit risk that is linked to a counterparty credit risk. You don't bear it. On the other side, if I have to wait for 29 days, I bear credit risk, because if you default during these 29 days, I won't be able to receive my payment. And that's why in market risk management, we try to avoid having long periods of negative values of trades, because we have to manage this credit risk. We have to hedge it somehow. And that's why I focus not only on time value of money, because time value of money is a very simple notion. It's a very simple thing. It has no link to any default, any timing. It doesn't account for any case of default, for any default probability. When we talk about present value, about time value of money, we consider timing. But the longer is this time to maturity, the longer we have to wait, the higher is the probability of a default of a counterparty during that period of time. And that's why there are two different notions. When we don't think about any risk of default, we use simple present value of money. We don't think about any default, and various counterparties are identical. We don't think that any of our counterparts by default. If only we consider any default, any probability of default, the probability of default is not zero. In this case, we cannot operate such a simple notion as a simple present value. We have to account for a default probability. And that's why I added this advanced topic to this lecture, to make a bridge between simple derivatives and their pricing and advanced notion of credit risk, counterparty credit risk. So we're gonna talk about credit risk later, and what we have here is equity swap. I have already explained you this instrument at the beginning of the lecture. We have three major types, and I have already explain the use of equity swaps. So we're not going to focus on equity swap in details because it's very similar to what we have in currency or interest rate swaps, because the idea is absolutely the same. It's just a repeat of the same ideas. What is important, the equity return, it might be an equity return, individual stock or index or ETF or whatever, any equity-like security. So there are different combinations: equity vs fixed, equity vs floating, equity vs equity. As for pricing and valuation, we have absolutely the same thing as we have in interest rates or currency. So if we enter into receive equity index and pay fixed swap, this equity swap cash flow can be calculated as follows. We have to multiply this contract notional amount by difference between returns. So if we have index, we have, in this particular example, quarterly payment. So if we have 1.6 annualized, we can see that index pays 0.4 quarterly. Fixed 1.6 annualized and 0.4 quarterly. The index return is negative. So the equity cash flow is notional multiplied by return difference. We have 0.4 fixed. We have 0.004 I'm sorry, we have 0.4 for index minus, that's the first in parentheses. We have 0.004, that's fixed rate payment. So this is 180,000 euros, that's the payment. It's a very common thing that equity is reported quarterly. Sometimes I think that's the most common thing, that the equity is reported quarterly, because these instruments are linked to dividend payments. Sometimes they're reported semi-annually. So as for pricing and valuation, we derive these formulas absolutely the same way as we did. So we have to denote the periodic return of the equity. We have to define the notional amount, the accrual period for fixed cash flows, a fixed rate. So everything is just the same. As far as you can see, we have the same thing for fixed rate. The way we derive the fixed rate is absolutely the same as we did before. So that's why I'm not focused on this. We have the equity swap value. How do we derive the equity swap value? The same thing. So equity swap at initiation has 0 value, and we value it as we do with interest rate swap, except that we don't have to adjust a floating rate. We adjust the notional amount of equity. That's the difference. So here is the equity. As far as you can see, we have PV par minus NA sub E. NA sub E, it is the notional amount of equity. And altogether, PV from par minus NA sub E is the present value function from time t to the swap maturity. So it's a function. It's not something that we have just. It's not two numbers. It's a function. So, and here is the example. So I hope that you can study this example on your own, because there's just absolutely the same thing. We summarize present values. We have to, so here I've got PV fixed cash flows, that's the total. And here I've got total minus the difference between rates multiplied by notional. So that's looks quite similar, but you can start with this example. If you have any questions, you can ask me. So the core things, we have already started the core things, and now some interesting things that can be used. We can have swaps with embedded options. That's a very famous thing, and credits with embedded options or swaps with embedded options is a product that is like tailored product, everything for the client. So these products are issued mostly by investment banks to offer their clients a wider opportunity, wider options. So while accrual swap is the contract that the interest on one side accrues only when the floating reference rate is within a certain range. So it resembles something like option, and this accrual swap is really difficult to price, and that's why you see no pricing formulas. Cancelable swap is in fact a swap with embedded option, because you have an option to cancel the swap. It's a look back option. The accrual swap is a look back option. A cancelable swap is a European option and a swap, or a Bermudian option with a swap if you have a number of different payment dates. If you have a wider period, it might be an American option or ASEAN. So these instruments are really difficult to price, and we're not talking about these pricing formulas and we're not going to discuss them even during the options section, but it's just an example of what do we have in market. We mostly sell and price products that are really complex, like equity out callable swap on a basket, or equity out callable swap in a basket with a physical delivery, and so on. So I mean, 5 years ago, there were lots of simple instruments, and structured products were not widely traded. Well, in fact, they were issued, but it was not like they were famous like 10 years ago. Then, due to regulatory restrictions, a rise of simple derivatives started. The rise of simple derivatives, like classic derivatives, lasted till 2019, I think. And as regulator allowed us to issue some new complex structured products, and without any restrictions. Investment banks started to issue structured products, and I may say that there is a decline in simple derivatives contracts, and everybody is issuing structured products now. Okay, so we have already seen it 10 years ago. Everyone is issuing structured products. Well, okay, let's wait till the regulator will stop this activity by imposing additional reserve requirements on structured products, and we will get back to simple derivatives. So we have mortgage-backed swaps. Thankfully, we don't have this construction here in Russian Federation. So you can have a look at these various swap contracts variations. There are different types of payments, and so it's just like for info. If you gonna work with swapping operations, you will know what these things are. If you're not going with swap contracts, that's a bit useless info. So what about counterparty credit risk? So counterparty credit risk is type of risk that is linked to specific counterparty whom you contract a derivative contract. So if you have an exchange traded contract, exchange marginal requirements totally eliminate any risk. Central counterparty is your counterparty, and due to marginal requirements, depositing margin, you don't have to, you don't face any like credit risk or something. So we can talk about counterparty credit risk when you trade OTC contracts, swaps, forwards, some OTC options, structured products, and so on. So if the value is negative, the counterparty gets into financial difficulties. A financial institution could realize a windfall gain because of default of the counterparty. That's what I was talking like 10 minutes before. So if I have to pay you and you default, that is what we call windfall gain. I don't have to pay you because you as a legal entity just cease to exist. So if we talk about swap contracts, potential losses from defaults on swap contracts are less than potential losses from defaults on loans with the same principle, because the value of the swap is a smaller fraction of the value of the loan. So we don't exchange a notional. We have only these cash flows, these small cash flows. Potential losses from defaults on a currency swap are greater than those on an interest rate swap, because principal amounts in two different currencies are exchanged in contrast to what we have for interest rate swaps. That's the difference. So I hope that you can distinguish the credit risk and the market risk. So when we talk about the market risk arises from the possibility that market variables such as interest rates, exchange rates, or equity prices, or whatever, move into an unfavorable destination. The credit risk arises from inability of the counterparty to fulfill its obligations. So these two types of risk are different, and you can easily hedge market risk. You can enter an opposite position. So if you'd like to eliminate any interest rate risk, you can enter swap contracts. You can avoid any floating rate instruments and focus on fixed rates. So you can enter opposite transactions. And then if you'd like to eliminate any risk linked to US dollar and you'd like to remain in rubles, you can enter transactions that convert US dollars into rubles. And that's going to be a way of eliminating currency risk. But as for a credit risk, it's really difficult to hedge it. What should you do to eliminate risk of default of your counterparty? There are no CDS contracts on single names, on majority of single names. There are no CDS contract. You cannot purchase an insurance because, in fact, you can. But there are so many stories that that's a very common thing. It's when a default of a corporation triggers a default of linked insurance companies. So in fact, credit risk is really difficult to hedge. So the reserve requirements imposed by regulators is how banks are forced to hedge credit risk. So even for a simple bond, a financial institution has a bond on its balance and the credit rating of a bond issuer is low, the regulator imposes reserve requirements on these financial institutions. So you have to reserve a certain amount of funds and you are not allowed to spend this money to do anything with this money, just keep them on a reserve account. And if your counterparty that has issued a bond you have on your balance default, the regulator believes that you're gonna use this reserve money to pay your debt, to pay out your liabilities, and this how financial system creates a self-insuring mechanism. This idea was provided by the second and the third Basel, and as for the Russian Federation, and as for the UK and the US regulators, central bank, FCA, Financial Conduct Authority, and set of regulating bodies in the US. The most famous is Securities Exchange Commission. They impose very strict reserve requirements. And so the strictest requirements worldwide are in Switzerland, like even exceed what they have in Basel. So we have the strictest reserve requirements in Switzerland, then what is recommended by Basel, then some countries like Singapore. Singapore is known for strict reserve requirements, and then like the rest countries that accept Basel. So Switzerland is even stricter than what is recommended. So we have three notions that are linked to credit risk. So credit risk is the risk of default on a debt that may arise from a borrower failing to make required payment. Counterparty credit risk is the risk the counterparty to a transaction could default before the final settlement of the transaction's cash flow. So credit risk is what is linked to borrowing. Counterparty credit risk is what is linked to derivative transactions. And we also have primary risk. This type of risk is defined as the risk that occurs when exposure to a counterparty is adversely correlated with the credit quality of that counterparty. So when default risk and credit exposure increase together, I mean, the more a party gains on a trade, the more likely the counterparty defaults. If I say, dear students, I can give you 100 US dollars for the weekend, and the interest rate I require is 20%. 20% is enormously high interest rate. The one who would accept this offer is the person who has literally nothing to lose. Right? 20% for 2 days, that's incredible, that's nonsense. If I say that, dear students, I can lend you 100 US dollars and I require 1 cent for this amount of money for the weekend, everybody would like to borrow. So it's not a very deep example. It's just to show that sometimes the more I expect to gain, the higher is the probability of a default. So if I enter a trade, an unfavorable trade, it's very likely that the counterparty that enters a trade on unfavorable conditions is likely to default. So here are some notions that we work in market risk management. You can have a look at these notions. There's nothing specific here. So I'd like to focus on this formula. So expected loss, what I expect to lose, is the probability of default. That's a very clear notion, multiplied by exposure at default. What I expect to lose, what is the sum under risk, multiplied by LGD, loss given default. That's a percent of loss. If I lend $100, exposure at default is $100. If I do believe that I can get half of this sum, the loss given default is 50%. If I believe that I can get like 10% of this sum if you default, loss given default is 90%. So you can have a look at different ways of determining the probability of default. So sometimes CDS prices are used to find out the probability of default. Bonds or equity price movements, there are lots of different models how to find out the probability of a default to the selected counterparty. So the most common thing is, in theory, is extracting probability of default from CDS. The theory looks very smooth. It's brilliant. That's great. But the problem is that when you'd like to estimate the probability of default on Ural Coal Company or, I don't know, Southern Russian sugar producer, no one trades CDS of these producers and these farming companies and so on. You just don't have these instruments. You cannot extract the probability of default because you don't have these CDS. So in fact, we try to extract probability of default from everything. I mean, financial statements. Okay, let's try. Stocks analyzing models, bonds, whatever. So in fact, there are lots of nice theories, but mostly we use the approach based on available data. So it's not very common that we have lots of different bonds, equities, and CDS. So the part of this topic is not included into any quiz or test, so it's just what you have to know. So you can study these extracting probabilities of default from CDS, but note please that in practice, there's a tricky thing. If I'm particularly interested in a specific counterparty probability of default, and I try to use my own models and so on, it must be a very unknown company. And if I'm particularly interested in developing my own models and so on, and if its company is a not well-known one, I would obviously won't be able to find any CDS or anything. So, and that's why I don't focus on extracting this probability of default from CDS like a part of this course, and that's why I don't give any tests, because in practice, I'm pretty sure that even if you join the quant team, you won't do this job, because it's a very common thing that we in practice act like this. So if you have any questions, you're welcome. I'm going to send you these slides if you'd like to study this probability of default and something. You're welcome. As for the test, I thought that it would be probably better to start your new test on Monday after you finish the Monday lecture assignment, because I think that it's a bit too much. So what do you think if you just complete the Q4 test and start a new one on Monday? Because I don't want you to have like too much work. We agree. So at least one student agrees, because I really want you to know the subject. And I think that most of you are going to work with Q4 during the weekend. Okay, at least 2 students. Deal. So I'm going to send you this file. Read it carefully. Don't hesitate to ask me questions. Have a nice weekend. Thank you for joining. Thank you for tuning in.
I have a question about master thesis topics.
Sure.
1 second, please. We have the topic modeling the derivatives market for electricity in the Russian Federation on the example of existing markets, USA, Europe.
Great.
Please explain what is it about? Is it about a creation of index for Russian Federation electricity market and then hedging electricity through this index, or it is something another?
So as far as I know, in the US, there is an energy market that's like an energy. So they sell energy. There are companies who purchase energy. They store it. I mean, energy like electricity, because you can store it. They store various types of energy. And this market is an old one. So, I mean, the Enron scandal was tightly bound to the energy market. And as for the Russian Federation, we don't have these like formalized. And I think that we can describe what we have here compared to what they have in the US. Probably we can introduce notions, indices, rules, whatever, that might make energy trading in Russia comparable to what they have in the US.
Okay, thank you. So as far as I understood, it is more about commodity derivatives, yes?
Futures, commodity, commodity futures, probably options. But in fact, if you were interested, well, energy trading is, to be honest, today they distinguish between energy trading and commodity trading. They focus on energy trading. This is there are some types of instruments that don't exist for the rest of commodity, like coal, cattle. They distinguish what they have for energy. I mean, we don't have like cattle futures, 3-month cattle futures. That's we just don't have it. But basically, that's about commodity and about specific instruments and strategies and approaches that are used in commodity energy markets.
Okay, I think maybe I will discuss with you later.
Sure, I think that it would be better if we exchange emails like your ideas. What do you think might be interesting as part of your research? And I can share my thoughts a bit.
Okay.
Okay. So, what's about any questions, ideas, something? Okay, so you have to complete the quiz, the 4th quiz, and you will get another quiz on Monday. I wish you a pleasant weekend, nice Saturday. I was happy to hear you. Bye.